Welcome to the Power Trading Coach channel. Today I will be discussing about CASA ratio. This is a financial ratio used in stock market. So let us go through this and understand how it is important and how you can use it while choosing the stock for trading, especially from the banking sector. So first let us understand the concept about what is a bank. Bank is a financial institution. It has a license from the central bank. In this case, in India, it is RBI. So RBI provides the banking license. So based on the license provided to the bank, a financial institution, as a financial institution, it can accept deposits and disperse the loan. So that is the major part of the bank. There are other tasks also bank does, but for the simplicity and for the sake of this particular session, we'll be only discussing about the deposits and the loans. So bank provides a safe place to deposit our money. So basically we deposit our money in the bank, and in lieu of that, bank pays interest on those deposits. Also, some of this money which has been collected, so that bank uses and provides that as a loan for individuals as well as business, and also it collects the interest on those loans. So in summary, bank accepts deposits and disperses the loans. So there are various accounts which are opened in a bank, but for the sake of this session, we'll consider three type of accounts. First one is current account. Also, it is called checking account. Second one is savings account. Salary account is also one of the type of saving account. And then we have the third one, fixed deposit accounts. So let us see what are these accounts for. So the current account is used by businesses mostly to manage their day-to-day business transactions, such as receiving the money from the customers for the services they have rendered or the products they have sold to the customers. So customers will be paying them. So that amount comes to current account. Also, the businesses will be paying to their vendors, suppliers, and also they will be dispersing the salary to their employees. So all this comes from the current account. Current account does not earn any interest, and it doesn't have any due date. That means it is a non-term deposit. There is no fixed term for the account. So it can be used as long as business wants to use it. And it doesn't earn any interest, zero interest on the current account. So due to the nature of this account, and also since businesses have a lot of transactions on a daily basis, higher number of transactions are allowed in this account. Also, higher cash deposits and withdrawals are allowed in terms of limits. Overdraft facility also will be available on the current account, wherein businesses can withdraw the amount more than what is there in the account. So this is called as an overdraft. So that also will be available for the current account. There may be a situation where individuals also may have a current account. Mostly it will be businesses, but individuals also can have a current account. It is also called a checking account. For example, in US, it is called checking account. And this account is liquid. That means you can deposit and you can withdraw money as many times you want. So it is liquid. Immediately the amount will be available for withdrawal. Let us look at savings account. This is used by individuals, that's you and me. So generally we have a savings account, and that is used to manage the day-to-day expenses. So basically we'll receive the money from someone in the form of direct deposit to our account, like NEFT, IMPS, or somebody gives us a check and we deposit that, whatever. Also, some of the savings accounts can be also be salary accounts. So if you are working in a company and if you have opened a salary account with a bank, so you will also receive the salary in that account. And savings account is basically an interest bearing account. That means you get a interest, but it is a moderate interest, not a great interest. And interest is also calculated, interest amount is calculated using the simple interest calculation method. So basically every 6 months in India, every 6 months, banks will deposit the interest earned on the savings account. So it will be done using a simple interest calculation, not a compound one. And also they will look for the minimum balance which is available every month, and they calculate every month but deposit once every 6 months. And it is using simple interest calculation method. This is also non-term deposit. That means it doesn't have any end date. It is open. There is a limit on number of transactions. I mean, savings accounts also have, they also allow number of transactions, but there is a limit for that. Each bank will have a limit in terms of how many transactions can be there in a month or year, right? And there will be limits on cash withdrawals. For example, some banks allow maximum, let's say 50,000 per day. So you cannot withdraw more than that. Okay. If you want to withdraw more than that, you need to go to the bank. Okay. And it is ideal for emergency. That means if you want to keep the money for any emergency purposes or day-to-day expenses, you can keep the money in savings account. This fund is totally liquid. This account is totally liquid. That means anytime you can withdraw. And nowadays, everyone has debit card and also digital way. They have access to their account, so they can transfer the money anytime, even on weekends and holidays. No need to go to the bank. So this amount is kept in the savings account for a short term. So if you are receiving the salary in this account, you will also have the every month the amount deposited, and whatever you spend from that, except that remaining amount will be in this account. Now, if you have some extra money which you are not going to use, so after your expenses for the month, you still have some money. So you can use that money and create a fixed deposit. And fixed deposits will have term. That means it will be opened for a particular term. For example, 6 months, 1 year, 5 years, and so on. Generally, fixed deposits will receive higher interest compared to savings account. And in this case, the rate is used to calculate the interest, and it is calculated using the compounding method. That means compound interest will be applied while calculating the interest on fixed deposit. Fixed deposits are not liquid. That means you cannot, every day you cannot go and withdraw the money and you can again deposit the money. So it is a contract. Once you open a deposit, you will get a receipt for that, either digitally or physically, whichever way. Now it is all digital. So you cannot withdraw the money until the maturity, but there are exceptions where you can foreclose the FD before the maturity date, but it is subject to a penalty being applied from the bank. That means, suppose if you are getting, let's say 7% interest on a 1 year deposit, if you close before 1 year, bank will charge you certain penalty. For example, it can be 1%, okay, as a penalty. So that is the penalty for premature withdrawal. So most of the time we never foreclose the deposit. So this is kept for a purpose, for investment purpose. So we generally don't touch the fixed deposit, but it can also be closed before maturity, but subject to a penalty. So not like very liquid for day-to-day transactions. Since it is a contract, it doesn't have any impact on the rate changes during the term of the deposit. What it means is, so for example, if you open a deposit for 1 year, within 1 year, many times the fixed deposit rates can change. But since it is a contract, the FD will have a constant rate which is mentioned on the FD while opening the FD itself. For example, if you get a 7% FD up to 1 year, if you have invested, so during that 1 year, even if rate goes down or rate gets increased, there is no impact on the fixed deposit because it is a contract. Whereas if there is a change in the rate for savings bank account, it will be effective at that time. For example, let's say savings accounts you get 3%. If bank decides that savings account interest need to be changed. So if they make it 2.5%, 2.5% will be applicable because it is not a contract, whereas fixed deposit is a contract. And interest is paid on maturity as per the contract. That is what is mentioned on the fixed deposit. Now let us see how banks make the money. Banks have a lot of money in the form of money in the current account, savings account, and fixed deposit. Basically, all this is borrowing. The bank has borrowed the money from you. You have given the money to the bank. So this money is a input for the bank. Bank is in the business of providing the loans to the eligible individuals or the businesses, and in lieu of that, they charge a interest on the loans. And loan interest will be a revenue for the bank. So the bank will have a lot of accounts like this: current account, savings account, and fixed deposit. So a lot of money is available in the bank. Now bank uses this money to provide loans, but they cannot give all the amount in the form of loan, because if you go to bank tomorrow and if you want to withdraw the money from your savings account, or if you want to foreclose the deposit, or you want to withdraw the money from current account, if bank gives all the money in the form of loan, there will be a problem. That's why there are certain rules based on which banks will decide a percentage of the amount which they can use and lend that to the businesses and individuals. So the typical loans are house loan, personal loan, education loan, loans to start a business or to improve the business or enhance the business, and there are other loans also, but for the sake of simplicity we'll use these are the type of loans. The interest on the loans will be higher than the interest on the fixed deposit. So if a fixed deposit, if you are getting 7%, the loan will have higher than 7%. As an example, the difference between the interest received through loans and the interest paid on deposits, that difference is called markup for the banks. So let's see how the markup works. The formula for the markup is interest received by the bank in the form of interest charge on the loans, basically the EMI, right? That will be the revenue to the bank, whereas banks will pay the interest on the deposits, whether it is a savings account or fixed deposit account, they need to pay the interest. So that will be an expense to the bank. So markup is nothing but it is interest received by the bank, which is also called revenue for that, and interest paid by the bank, that is expense. So profit equal to revenue minus expense, or markup equal to interest received by the bank minus interest paid by the bank. Now if you look at it, the percentage of interest on the loan will be always higher. Let us take an example. The rates shown here on the slide are not the real rates. They are used for illustration purpose only. So these rates will be changing. So always check the latest rates at that time. But for the illustration purpose, let us assume the loan account has 9.5% interest rate, 9.5%. So if you take a loan from the bank, so you need to pay 9.5% interest. Now, on the current account, there is no interest rate, 0%. Similarly, on the savings account, let's assume 3.5% interest is paid. Okay. Then fixed deposit account will have 7% interest, let's assume. Now, if bank has to use the money from current account, savings account, and fixed deposit, so what is the best way of using the money? All these are borrowings. Basically, savings account, fixed deposit, they have to pay the interest, whereas current account, they don't have to pay any interest. Now, if they take the money from current account, they don't pay any interest. That means expense for them is 0. But if they get 9.5% loan, then the markup will be interest received by the bank, which is 9.5%, and interest paid by the bank, which is 0. So the markup will be 9.5%. And if they use the money from savings account, it will be 9.5% minus 3.5%, which is 6% markup. Similarly, fixed deposit, it will be 7%, it will be 9.5% minus 7%, which will be 2.5% markup. So which is better for a bank? Is it better to take the money from current account, savings account, or better to take from the fixed deposit? In fact, bank will use each of these buckets. They'll take the money from each of these buckets, each of these accounts, and provide the loan. But for them, the current account is always better because the expense is zero. Savings account, some expense, and fixed deposit has higher interest outgo. So the profits will be more in current account compared to the savings account, and savings account markup will be better than markup in the fixed deposit. Now let us see how the borrowing cost will impact. Borrowing cost on the current account and savings account, as you saw in the last slide, previous slide, borrowing cost is lesser than the borrowing cost on the fixed deposit, because the interest paid on the fixed deposit is always higher than interest paid on the savings account. Current account does not receive any interest. Now markup on the current account and savings account will be higher than the markup on the fixed deposit, as you saw that 9.5% on current account markup. Savings account, it will have how much it was, 6%, and for fixed deposit it was 2.5%. So the markup on the current and savings account is always better than the markup on the fixed deposit. Now let us look at the total deposits. The total amount together in current account is called CA. First two characters of this is used, CA, and the savings account first two characters is CA. So together if you add, so it will become CASA. So the money, if you add the money in current account and savings account, that is called CASA amount or CASA deposit. Now the CASA ratio is calculated as below. So what you have to do is, you have to calculate the total deposit in the bank. Total deposit in the bank is nothing but the money in the current account and savings account, which is now called as CASA deposit, right? Plus the fixed deposit. Now that is the total deposit in the bank. CASA ratio percentage is calculated as CASA deposit into 100 divided by total deposits. That means CASA ratio is basically the ratio of CASA deposit to the total deposit. CASA deposit to the total deposit. So let us see an example here. Let's say bank A has 60 crore. Everything is crore here, let's say. Okay. So if it is a crore, 60 crore, savings account 20 crore. So together current and savings account 80 crore amount is available in the CASA deposit. Fixed deposit has 120 crore. So if you add the CASA deposit and fixed deposit, total deposit in the banks will be 200. Now, if you look at what is the CASA deposit compared to the total deposit in the bank, so which is 80 divided by 200. 80 divided by 200, which is nothing but CASA deposit divided by total deposit into 100. So when you do that, 80 divided by 200, that means for 200 if it is 80, for 100 it is 40. So it is 40% CASA ratio. Now for the bank B, it also has the same total deposit of 200 crores, but the numbers are different. Current account has 90 crore, savings account has 30 crore, together it has 120 crore, and fixed deposit is 80 crore. So again it has 200 crore. Now if you look at CASA deposit with respect to total deposits, it becomes 60%. If you calculate 120 divided by 200 will be 60%. So that means higher the CASA deposit, higher the CASA ratio. Higher the CASA deposit, higher the CASA ratio. Now, higher the CASA means higher money in the savings account and current account. It can be also salary account, because salary accounts are also in the form of a savings account only. So that means in the first case, first bank, 40% of the money is in the CASA deposit compared to the total deposits, 40%. That means this is a easy money. So it has less cost to the bank. Now in the case of bank B, it has 60% of the money in CASA compared to the overall deposit. That means this is much better. Higher the CASA ratio, it is much better, because the cost of borrowing for the bank, cost of borrowing is they have to pay the interest, right, on the savings account and fixed deposit. So the cost of borrowing is much cheaper because they have 60% of the money in the CASA deposit. So they can use this amount to pay the to basically provide the loan, disburse the loan. So higher CASA means higher profit. Now let us see how the CASA can be improved. CASA is based on the CASA deposit. Higher the CASA deposit, higher the CASA percent. CASA means what? Current account, savings account. If you observe, typically banks will be requesting you to open the salary account with them, and they also go to the employer and they request to open the salary account with them. Why do they do so? And if you open a salary account with a bank, they will provide you the facilities in the form of debit card, credit card, and all. Do you know why? Basically, the banks will be looking for salary accounts, because if they have a salary account, they can have a big number of salary accounts with them, which are basically the savings account. And most of the time what happens is, if they are providing a salary account to their employees, the employer will also open the account with the same bank. That means the current account of the business, that company, will also be with the bank, which means huge amount of money, because businesses will have lot of money. So in the current account, lot of money will be there, which will be used for disbursing the salary, payments to the vendors and suppliers, and also it receives the money from its customers, as we saw in the first slide. So if they open many such salary accounts for various companies, then they will have so much of money in the CASA. So current account, no interest. So that means a good amount of money will be there from various businesses. And if there is a salary account, that will also means a lot of money will be there, and a lot of new accounts will get created in the bank. And generally, for a salary account, the bank will say it is a zero balance account. You can have a zero balance account. Now think about it. Anytime did you keep zero amount in your bank, especially the salary account? Never. Because generally we save the money, right? We don't spend all the money. Always there will be some amount left in the savings account. So we don't spend all the money. That means even though it is a zero balance account, nobody actually keeps zero. That means always there will be money in the savings account or the salary account. And since it is a digital age, you don't have to keep the money in house, your home, for emergency, because you can always use your mobile, or you can use your debit card, and you can always withdraw the money or pay to somebody. You don't have to go to the bank. Earlier, those days where if the bank closed on weekend and if you require the money, it would have been difficult in case of emergency. But nowadays, it is not like that. So that means you don't have to withdraw the money unnecessarily. You withdraw the money or you spend the money only at that time you take out the amount from the salary account. Rest of the time it will be in the salary account. That means huge amount will be available in those accounts. So because of this, the CASA ratio or CASA deposit will improve for the bank, and hence the CASA ratio. Higher the CASA ratio, lower the expense to borrow the money. Why? Because CASA is what? CASA ratio is dependent on the CASA deposit. Higher the CASA deposit, that means you have a lot of money in the form of CASA deposit. 60% of the money in the overall deposits is coming from the CASA. That means you can utilize that money, which is less cost to the bank. So banks will be earning more profit. The markup will be higher for them. So if there is a higher profit, automatically the bank's stock price also goes up, because the earnings, if you look at the profit, what is the formula for profit? Profit equal to revenue minus expense. If your expense is reduced, then profit will increase. And if profit increases, the value of the bank will increase. That means in turn the value of the shares will increase. So hence CASA ratio is one of the financial parameters to compare the banks while investing in the stock market in the banking sector. So if you want to invest in a bank, so this is one of the parameters. Don't judge don't make a decision only on this parameter. You need to look for other things as well. But this is one of the financial parameters which will say how best the bank is utilizing the money to provide the loans at a lower cost to the bank and higher markup to the bank. So that is what the CASA ratio indicates. So let us look at the CASA ratio for different banks. So in this slide, I have shown the banks which are part of the Bank Nifty. Bank Nifty is an index. It is a sectoral index in National Stock Exchange, NSE, in India. So as part of the Bank Nifty, these are the banks, and I have taken the CASA ratio information for the quarter ended March 2023. So if you see, you can see the CASA ratio for each of the banks here. If you observe, Federal Bank has 32.86% of CASA ratio. That means only 32% plus amount is coming from the current account and savings account. That means vice versa, around 68% is coming from the fixed deposit. Whereas if you look at Kotak Bank has a higher CASA ratio of 52.82. So this will be very useful for this bank to have a higher markup, higher profit. So this is how the CASA ratio is used to compare the banking stocks. So next time when you compare the stocks, look for the CASA ratio. The bank which has a higher CASA ratio will have a higher markup or less expense and higher profit. So this is about me. My name is Ganesh Joshi. I am an engineer in computer science by education. I worked in Central Government of India in my initial career as a class 1 officer in Delhi. Then I also worked in top IT private companies in India, and also worked in USA in one of the US based company. All these were in the information technology field, and I worked for 30 years in the IT field, and worked in senior technical and management roles during this period. I have a passion for mathematics, finance basically, and stock market in particular. That is my passion. So now I'm a full-time professional trader in stock market. So former IT professional turned into full-time professional trader in stock market after working in 30 years in IT sector. I'm a professional stock market trader, which I was continuing from last 12 plus years, and I have expert knowledge in trading and have trading experience in all asset classes such as equity, futures and options, currency futures, currency options, commodity futures, commodity options. So basically all the asset classes. And I have expert knowledge in these areas. So finance, stock market, taxation and insurance. I am also a professional trader in stock market in all asset classes and have trained many members in last 5 years. Trainings are available for basic, advanced and super advanced levels. So if you want to know more about how to contact me, you can go through this. So I have a YouTube channel, Power Trading Coach, and I have a Telegram channel where I share knowledge about stock market, and I have a Twitter account also, X now, and you can approach me by email at powertradingcoach@gmail.com, and I have a Google form for training inquiry, the link for which is given here. So thanks for your time, and I will be sharing more such knowledge sharing videos in the upcoming series. Thank you.